Joe, one of the biggest ideas in your work is that retirees should not focus only on their tax bracket. What is the effective marginal rate and why does it matter so much in retirement?
Sure. You can really think of it as just the question, how much more does it actually cost me? That's the effective marginal rate. And the idea out there of a marginal tax rate is one thing, and that's what happens just on the 1040. The reason we started talking about effective marginal tax rates are there are things that don't happen on a 1040 that matter to retirees. When you think about, I think about lower income retirees that have homestead exemptions, especially towards the end of life. That's a perfect example of something that doesn't show up on a 1040, and it can be massive, $5,000-$6,000 a year. So for a lower income retiree, that's something you would consider as part of this effective marginal tax rate process. And IRMA is another one. IRMA is the opposite example. IRMA is the one that probably most of your listeners are familiar with, but it doesn't show up on the 1040. It's triggered by what happens on the 1040, but it doesn't show up there.
So it is indeed a case where just one extra dollar from an IRA can end up costing far more than people expect.
Oh, for sure. And especially true with IRMA, especially true with the ACA phase outs. That $1 that takes you over the 400% of poverty level threshold that completely wipes out an ACA subsidy. That one can be really painful if you don't see it coming.
Was there an aha moment in your career that convinced you that retirement taxes were much more complicated than most advisors realized?
Well, I think probably every advisor, the first time they see Social Security start to become taxable where it wasn't taxable before, you've commonly heard of that referred to as the tax torpedo. But it is such a massive surprise. And the second one is capital gains. If you've got someone who, middle income retiree, who's not used to paying tax on capital gains, and then one year they have a big capital gain and they get hit where they were normally in a 0% capital gains bracket, that surprises people. So I think most advisors have had either that or, again, on the high income side, that situation where you drag net investment income tax into the mix, and all of a sudden the bill's considerably higher than you might have expected.
So I guess income level matters a lot. How should people be thinking? Like, if they're a high income, are there things that they can be doing to plan accordingly versus somebody who's lower income? Do those decisions or levers that they can use have a much bigger impact?
Well, I wouldn't say they have a much bigger impact. I'd say the levers are a little bit different. And so, in my world, in my practice, I have really focused on middle and upper middle income people in retirement transition and beyond, right? So that's kind of where we live. And so most of what I talk about is not going to be the ultra high net worth folks. What I would say is that for, mom and pop, the average client out there who's saying, who do I work with that's going to understand this? The techniques that are going to be employed by someone who regularly works with the high net worth, the 10 million plus, versus the mass affluent, the upper middle income, are going to be different techniques. And those that work with lower income is also going to be a different set of techniques.
Yeah, taking a step back, once you understand someone's effective marginal tax rate, how does it change decisions like Roth conversions or retirement withdrawals?
Oh yeah, and that's just absolutely critical, is this idea of targeting over a lifetime, right? And so when we think about a lifetime of withdrawals that we're going to have to make through the course of a 30-year retirement, there will be changes in the composition of those withdrawals over time. And we commonly think in terms of phases. You've got kind of the pre-65 where ACA might matter. You've got 65 to 70, and that's the window where you've got Medicare, but you don't necessarily have Social Security. Maybe you do, you don't. You've got 70 when is the last time Social Security could have been elected, out till 73 or 75, where required minimum distributions start. And each of those presents unique opportunities to do tax planning, integration of this idea of which accounts do I use at which points in retirement, which techniques make sense to use at those points.
Any general rules of thumb?
Well, I think one of the biggest focuses for that first window, call it 60, call it early retirement, at the point that you retire up until the point where Medicare kicks in, ACA is a big one. It really is a big one. Sometimes it makes sense to be poor on paper in order to capture those ACA subsidies. Between 65 and 70, that's really where the Social Security decision comes in. And so, if I'm delaying Social Security, it's highly likely, especially if I'm married, that I'm going to get standalone benefit out of delay. That was back in 2013 when we wrote the Social Security Essentials book. That was a message that just wasn't that common. And, so we really felt like we had an important message to carry out to the world that, hey, there is a lot of value in delay and you want to understand these rules. At that time, we were really just focused on really small Roth conversions. And over time, those got a little bit more aggressive once we realized, hey, this window, it kind of closes, not all the way, but you've got a huge opportunity when you have complete flexibility over which accounts you're going to use. And when that flexibility starts to disappear, when Social Security kicks in, and then again, when required minimum distributions start, your flexibility goes way down. So it's like you really want to focus on those techniques in that window between retirement and when Social Security kicks in, and then again when required minimum distributions kick in.
Yeah, appreciate the context and you putting it into different phases that people can think about as they approach or they're in retirement. Let's go on to segment 2.